Capital gains tax, CGT. Not a particularly interesting topic, but something that comes up quite a bit. So today I thought I'd cover off some of the main points to be aware of should you happen to sell an investment one day down the line. Despite being called capital gains tax, it's not actually a separate tax with its own rate and everything. It more just refers to the rules for working out whether you made a gain or loss when you sell an investment. Before, that number just gets added to all your other taxable income and you pay tax on it all at the same rate. Think of it kind of like a salad dressing that you mix up before adding it to your salad bowl. It's a separate recipe, but it all adds to the calories, or the tax, and you end up paying for it in the end. Now, that's a pretty simple overview, and like most aspects of our Australian tax system, it gets a whole lot more complicated than that. And with the next election, it might be about to get even more so. So for now, I'm going to cover off the current rules that should, in all likelihood, continue to be the rules that apply to any investments that are already held today. CGT was introduced in 1985. Even today, if you sell an investment that was purchased before that date, it may be tax-free. Unless, for example, you do too much work to a property, or say the owners of the investing entity change a bit. There are a few ways that your tax can be reduced in the calculation. There's a CGT discount of up to 50%. Now, companies don't get access to that, but they do get access to the small business CGT concessions, as do most entities. Those rules are very complicated, but they could be very worthwhile, as they may even reduce your tax down to nil. So if you're thinking about selling a business asset, or even not yet thinking about selling, it's worth checking your eligibility today. Plan ahead. Something else that can reduce tax on capital gains is a loss. Usually, if you make a loss in the same or earlier year as you make a gain, you get to offset the two. Now, income tax gains or capital gains can be offset by tax losses, but capital losses can only offset capital gains. Think of it kind of like that thing where all thumbs are fingers, but not all fingers are thumbs. Timing can be really important. If you own two properties at once or start to rent out your property, you need to keep a timeline. Record when you bought and sold, when you started and stopped renting, and when you moved in and out. Those are all important factors for working out which property you want to be tax-free when you sell one and it comes to doing your calculations for the tax return for that year. I could go on. I haven't covered things like CGT for foreign residents, deceased estates, transfers to family members, but those are all good reasons to come and talk to us. If you have any questions on those topics or anything else I've mentioned today, please do get in touch. Thank you.